Hey everyone, thanks for joining us. I'm Chris Hill. Welcome to Fool Global Headquarters here in Alexandria, Virginia. I am joined by the Chief Investment Officer, Andy Cross. Thanks for being here.
Hey Chris, thanks for having me, man.
We got a lot going on today. We've got some earnings. We're going to be taking your questions, so go ahead and type those into the comment section. A lot going on. We're here in the thick of earnings season. But Andy and the team of Motley Fool analysts have been working round the clock, especially during earnings seasons.
Yep.
Put together a free report of 5 stocks. So if you're already a member of our Stock Advisor service, you already have access to this report. If you're not a Stock Advisor member, hey, no problem. You can get the report for free by going to fool.com/YT. Make it nice and easy with the URL. We've got 5 companies in the report. We're going to go in depth on a couple of them today. And let's start with Twilio.
Yep.
Fun name, the cloud communications platform.
Yeah, so what Twilio does is they provide tools and a platform for lots of big clients like Amazon and Netflix, Uber, to basically create communication pathways with their customers. So if you get a notice from Netflix, Chris, or maybe from Uber, which used to be a big client, still a client, but used to be a really big one, that communication is all happening with Twilio's tools that they are providing for those engineers at those companies to be able to build these tools. And I'm proud to say Jeff Larson is the founder of the company and a proud graduate of the University of Michigan. In fact, all his co-founders are also from the University of Michigan, of which I am a graduate. And they built this company. It's a $16 billion company today. It was founded in 2008. The stock has done just phenomenally well. It's growing very rapidly. And so when you think about all the communications we need to communicate and with both people, if you're a business, with your contacts, your clients, the Twilio applications are really in need, and so it's a very large market, and Twilio is providing these services that are very flexible, and developers love them. Twilio has an amazing culture that Jeff has built at his company with some really fun values that they have, like things like be bold, and really one of my favorites, which is draw the owl, which is really a sign of like how they think at Twilio, which is like, we don't know all the answers. How to draw an owl, draw a few circles, and then you figure the rest out yourself. So it's really an innovative culture that they're building there, and it's helping them have a business that is just growing like weeds, and it's showing in the stock price.
Well, and you think about the job they've done operating at Twilio. I mean, you mentioned a couple of companies, Amazon, Netflix. I mean, those are huge companies. Arguably, if they wanted to, they could build this kind of thing themselves. And I think it says something about the job that they've done that Twilio has provided the solution for them.
That's a great, because every time I research Twilio and I look at their client base, I say, can't these guys just develop them themselves? And that's true. And this new offering they have is Twilio Flex. Shopify is a very big customer. So another client, another company that we really like, and the fact that Shopify, which is very innovative, is using Twilio to manage their customer contacts and their relationships across thousands of Shopify users tells me that Twilio really is building a solution that is sticky, it works, it's seamless, and it's flexible so the engineers at these companies can take the tools and build the solutions they want, and it's working.
You look at this industry, who are they going up against? Because clearly, as we've talked about, there are plenty of companies that are willing to outsource this to Twilio. Who are they competing against?
I think when you look at you have to think about the really big tech companies out there, and Twilio is a tech company. Jeff founded it as a tech company and then said he wanted to build it first around engineers and then around salespeople. So they really have this engineering culture. One other reason why I really like it. So any of those tech companies that offer communication platforms and can provide like text messaging or email, Twilio very interestingly just bought SendGrid, which provides email messaging, which Twilio did not have. And so they recognize that, hey, we don't have this capability, so we're going to go out and buy it. And with a partner in SendGrid that brings in a lot of customers and gives them a capability in email communications that they didn't have. So they recognize they don't have all the answers, and they know there's a lot of competition out there, but let's find the people who have those solutions, maybe bring them into the Twilio family. And so I really respected that they could do that. Obviously, Slack is a communications platform, but Twilio partners with Slack in that regard in some ways. So just thinking through the market opportunity and the solutions they're building makes us continue to be very impressed and bullish on Twilio long term.
Last thing before we move on to the second company we're going to get into. You look at Twilio, it's a $16 billion company. They've done a phenomenal job growing that, but it is the sort of thing, they are still small enough, which seems a little odd to say about a company worth that much money,
Right.
but they are still small enough that if someone wanted to make them a Godfather offer to acquire them, they probably could. Do you get the sense that Twilio is in this for the long haul themselves? They want to stay independent?
I believe so. The company that Jeff and his team have built at $16 billion, phenomenal growth, grew 77% revenues last quarter, are now really starting to expand their ecosystem. They have very high retention rates, and they have revenue that is very recurring. And so they continue to have these businesses that are using Twilio, relying on Twilio. It's not profitable, Chris, like many of the SaaS-based software as a service companies are. They are generating some cash. But they're continuing to grow, and that profitability, I think, will come. But I don't see them right away looking to go into a larger family, considering the market opportunity that Twilio has.
All right, let's get to the second company in our report, and that's Workday. Not exactly a household name, but a pretty impressive job growing in enterprise software.
Yeah, it may not be a household name, but I'm gathering that many viewers probably have used Workday. Workday provides human resources and financial management software to very, very large companies. We're talking like 40% of the Fortune 500 companies. So your HR teams and your finance teams will use their software to manage things like payroll and other human capital management, which sounds rather Orwellian, but it's actually the term that everyone uses. So things like onboarding people, staffing people, hiring people, training people, developing people. Workday does that. And they also handle financial software that helps the finance teams being able to do their jobs much more effectively. It was interesting, it was founded by David Duffield, who founded PeopleSoft, and Anil Busri, who is the CEO. And they both worked at PeopleSoft, and then PeopleSoft was acquired by Oracle in this kind of a hostile takeover that wasn't very friendly. And then they spun off and in 2005 created Workday. And now it's a $40 billion some company. It's been growing exceptionally fast, very stable. It is really just the gold standard out there when you think about this kind of software. It has very large companies, very sticky software that when somebody gets into that, uses that software, they're not likely to change. And Workday continues to innovate that. They spend an amazing amount of dollars on research and development just to continue to innovate into their product suite and continue to offer the solutions to their clients and the customers that will continue to keep them spending more and more money with Workday.
It seems like a similar story with Workday, like we talked about with Twilio. I mean, yes, this is something that certainly smaller companies can do on their own, but if Workday is doing their job right, they make it almost a no-brainer for companies to just outsource this to them.
Oh, Chris, totally. I mean, it's all, first of all, it's all cloud-based, so it's all most of it's all off-premise, subscription-based. That's good for Workday. But if you are a large company operating very complex systems, lots of legacy systems, like from PeopleSoft or Oracle or others out there, and you're looking for a much more flexible, user-friendly interface for your employees, something like Workday is almost a no-brainer from a cost-benefit perspective. And just to be able to scale your organization as we all think about growing our companies and being able to hire many, many more people, to do that is very complex at very large levels, and so Workday is providing the solutions for these very large companies to be able to do it, and it's obviously working because their retention rates are very high and their cash flows and their revenues are very high too.
All right, if you want to check out the full report, the links are in the description of the video. You can go to fool.com/YT, and if you're enjoying the video, give us a thumbs up. We'd appreciate it. We're going to get to the questions. A lot of great questions coming in, but real quick, as I said, we're in the thick of earnings season. Yeah. Let's start with Microsoft. You look at their stock hitting an all-time high today. This morning, it briefly crossed over to the $1 trillion market cap mark. It dropped back down a little bit from them. Third quarter was really impressive, and for all the talk that we do about Amazon Web Services, and Amazon's done an amazing job with Amazon Web Services, Microsoft's work with Azure has been just as impressive.
Chris, almost across the line, this was just a really impressive report for such a large company. I mean, Satya Nadella, who's the CEO, who took over a few years ago, has just done an amazing job getting this company focused on the future. I think it was almost a joke 5-10 years ago before he really just brought this innovation culture into Microsoft. And you look at what they're doing with their cloud business growing so fast. The Azure cloud particularly was up more than 70% in revenues this quarter. The commercial cloud, the total cloud operations, which include like Office 365, which many of us use, Azure, the Dynamics cloud, that was up 41% over the year. So this is a company that's very large and still putting up those kind of growth numbers. It's really impressive. And that's not easy to do in a culture. I mean, Microsoft's been around for 40 years. So as innovative as it was when they started, it's hard to turn those cultures around, and what Satya has done at Microsoft is really one of the most impressive, I wouldn't quite call it a turnaround, but really a reinvigoration of what it takes to survive and thrive in a world of cloud-based distributed learning. They made the acquisition of LinkedIn, the acquisition of GitHub. Those are all playing benefits, and we saw so many of those benefits show up in the quarter this year.
And you talk about the reinvigoration of Microsoft with what Nadella did with the cloud, all while they continue to make money off of that subscription business with Microsoft Office. Yeah, it's just a cash cow for them.
It totally is. And Windows 10 now is active in more than 800 million devices. And I think it was Oprah who made a comment about 1 billion devices for Apple users. I mean, Windows 10 is not small. I mean, Microsoft continues to put up these really impressive numbers in this turnaround. Their Windows commercial business was up 18%. Gaming's a little bit, probably, if you have to pull out one little weak spot, maybe gaming was a little bit on the soft side, and I don't think up to their expectations. But the rest of the line, I mean, revenues were up 14% and earnings per share up 20%. They generate a lot of capital. They pay back the dividend, buy back a lot of stock, return to shareholders, and that's one reason why the stock price has done so well.
Last thing before we get to your questions, and keep them coming because there are some great questions coming in. Facebook, first quarter, record revenue, record profits. This continues to be one of those companies that I think defies expectations, certainly for investors who don't like what's going on with the privacy aspect of Facebook, and maybe they've deleted it from their phone or closed down their account and that sort of thing. Advertisers, though, continue to love working with Facebook.
Well, and Chris, I think the media loves to talk about what happened with their FTC charge. They took $3 billion, maybe up to $5 billion as a preliminary charge this quarter. So much talk about that, but when you look at the investing performance, the stock performance, the business performance, just really impressive. I mean, revenue's up 26%. Earnings per share, not counting the FTC charge, was up $1 up to $1.89. More than 2.1 billion daily users of the Facebook platform. So that's Facebook, Instagram, WhatsApp. Mobile ad revenues, Chris, as you mentioned, up 30%. So they continue to, while they face these struggles, and I think Mark Zuckerberg and his team has to get some credit for recognizing that, yeah, they dropped the ball on so much of this. And even the addressing of that drop ball wasn't perfect, but they're starting to get it more and more right. People continue to use those platforms, especially Instagram and WhatsApp, and they are starting to figure out better ways to monetize that. And like you said, the advertisers are continuing to care more about that. I think advertising placements across all their platforms were up more than 30% this quarter. So just continued impressive metrics from the business side for Facebook.
All right, let's get to the questions. And let's start with Michelle, who asks, what is your feeling about staying invested in Facebook with all of their ethics problems? And this sort of speaks to what I had touched on, where, this really hits people at a gut level when you start to dig into who has access to your data. And so I absolutely understand those concerns, but I think that, look, obviously, anytime you feel like there's an ethical issue, then maybe that's not a stock you want to be invested in. But as we talked about, advertisers look at Facebook as a must-have when they're looking at digital campaigns.
Yeah, I think that's right, Chris. I think they still have some challenges, and I think the advertising business might be, it's going to probably go through some challenge. It will go through some challenges. And we might still see some of the problems they've had on the privacy really impact who wants to buy advertisers and how. But their stories business continues to do well. I think, Michelle, your questions is really relevant. I continue to own Facebook shares and be impressed with the way that they are trying to manage this better and better, and with the assets they have. But Chris, you're right. if you don't feel comfortable owning a company that is tied in that way to privacy, you don't have to own the stock.
Turnips asks, post earnings, is Microsoft's valuation too high to get into now? Interesting question, because look, the $1 trillion market cap, even though they came in under that later in the day, I mean, that's one of those things that is such a huge number. I totally get the question. But that being said, even though it has a market cap of, let's round up and say it's $1 trillion, when you look at the stock, is the stock expensive?
I don't think so, Chris. I mean, now this is not a company that's, Twilio is up more than 3 times in value over the course of a year. You're not going to see that in Microsoft stock. You will, I think, continue to see impressive returns. Don't let the $1 trillion market cap focus too much, because it's the really per share that's the most important point. And they pay the dividend, they buy back stock. That will all keep the share price continuing to move higher along with the growth of the business. But when you look at the stock, Chris, it's not really all that expensive in the confines of the tech world. It's actually downright cheap. So it's profitable, generates a tremendous amount of cash. Satya is doing a lot of exciting things. So when I look at the future for Microsoft, yeah, it's not going to be a stock that's going to double overnight, but I think shareholders are going to be well rewarded by holding on from here. And if you are interested in buying into that growth, yeah, I think the price is reasonable here.
Coy asks, what do you think Warren Buffett's elephant gun is pointed at now? Little bit of explanation required here. Warren Buffett from Berkshire Hathaway has, for years now, talked about his desire to make an acquisition, add another company to the Berkshire Hathaway portfolio. He refers to his elephant gun, which is, of course, his gigantic pile of cash. He's got somewhere in the neighborhood of $80 billion he could deploy if he wants to. But I don't know, you look at his comments lately, it really seems like he doesn't see anything out there that he wants to buy, because let's face it, he's not going to overpay.
He won't overpay. We did a show on this, actually, one of our podcasts. We had done the show, like what might be out there. And I look at a company like maybe Sherwin-Williams. Companies, you're looking for companies that are probably in that, $30 to $50 billion range, which is a large company. Microsoft much bigger than that, so I don't think he'll go there. But if he does make an acquisition, I think it'll be somewhere maybe in the insurance space, or maybe in the industrial space, not so much in the tech space. But like you said, Chris, looking at the prices for the stocks, he's probably thinking things are somewhat a little bit elevated after this run. We've had an amazing bounce back in the first quarter. So I don't expect him to make any big announcements anytime soon on a complete acquisition. He has certainly been patient and certainly looking for that. So I wouldn't be surprised if he does in the next few years, but not in the next year or so.
And it's a great question, Coy, and one that I expect will come up not this Saturday, but the following Saturday, Berkshire Hathaway annual meeting, which for those who haven't seen it, Buffett is famous for him and his right-hand man, Charlie Munger, just sitting up on stage, taking questions from the audience for hours. Really impressive to see.
Very.
Several people asking about Zoom. A lot of hype around Zoom, a recent IPO, the shock startup. You've looked at Zoom. Do you look at it right in the wake of its IPO and think, yeah, this is something I want to buy right now, or do you want to see how they do after a couple of quarters?
No, I think it's a great question, and Zoom is a very impressive company, and I've read through the filings and listened to their CEO and their co-founder and their founder speak. And it is very impressive. It's profitable. It's growing very fast. And they have a sticky business. And this is another one of those businesses, Chris, that really has innovated in a space where you have a lot of competition that just has really kind of dropped the ball, right? Like including Microsoft, including Cisco. And Zoom has been able to really do something pretty impressive there. And we use Zoom here. I do think the stock price has performed so admirably after its IPO price. There's no rush to get in. On the flip side, if you do want to take a little bit of a nibble and bite and get started in Zoom, that's great. IPOs tend to be kind of hot. They drift off a little bit after a few months. There's some blockout periods with when insiders can sell and when they can't, which puts a little pressure on the stock. You really, really, Chris, have to take that long-term perspective if you're investing in Zoom. Don't trade around it. If you're buying into it, you got to buy in for the next 5 years, as we think here at the Motley Fool, because the stock will be exceptionally volatile during that time.
Well, and for those unfamiliar with Zoom, this is a video conferencing company. I'll just say from a user perspective, we've been using them here at the Motley Fool. The interface is incredibly easy to use.
Yep.
I'm not a tech person, I can use Zoom.
That's right.
So
it's very
they got that going for them.
That's great.
What do you guys think about pot stocks? Great question from Kevin.
Well, there's obviously a lot of conversation. It's all over the media, of course. Right up there with the IPO market. And I think there are some that might be some that are good and some that we like. There's a lot of hype out there, so you have to be very particular and very careful on what you're grabbing. And we do have some conversations about and some recommendations around some of the pot stocks. I think in generally, again, if you're taking that, you have to take that long-term perspective. You certainly don't be going down into the penny stock range and companies that are more speculative. But in the larger cap range, there's probably some that are going to be a little bit more impressive and will be a winner in that space. Clearly, the market is really evolving and changing and growing, both in Canada and the U.S. and actually around the globe as well, too. So I think there are some that are going to do well. There is a little bit of, not a little bit, there's a lot of speculation and you have to be careful about, too.
Nathan asks, what do you guys think of Mercado Libre? It's up over 60% so far in 2019. Is there more room to run? Great e-commerce company in Latin America.
Simple answer is yes. When you look at the Mercado Libre market cap versus something like Amazon, I know that's comparing it against one of the best companies in the world, but just the opportunity to be able to grow in the Latin America and global space, but particularly in Latin America for Mercado Libre, there's plenty of room to run. Yes, the stock has had a nice run, as many tech companies have. It hadn't for a while. It had really struggled a little bit, and it is tied to some of the global concerns that we hear a lot about. But from a growth prospect and from a really delivering for customers, Chris, I think Mercado Libre has a lot going for it. So I would expect to look out 5 years and see that stock higher.
We got a question from Marvin. What do you guys think about Amazon's earnings report? Amazon reported while we were doing this, so let me just hit you with a couple of the headlines here. And it looked like a blowout quarter. First quarter results for Amazon. Earnings per share came in, I would say, a good 70% higher than analysts were expecting. Revenue sort of right in line. We were talking before about Amazon Web Services coming in close to $8 billion in revenue. So I would expect that shares of Amazon are going to be up tomorrow, but it is interesting to see what happens on the conference calls and the questions that analysts tend to ask during those. But on the surface, it looks like Amazon put up a really solid quarter.
Yeah, the thing that I think that I'm really interested in when I look at the Amazon story is just their continued growth in the advertising space. They now, Facebook, Google, Alphabet, largest advertising platforms online. Amazon is quickly making inroads into that space and starting to grow their advertising base on their platform as well too. So continued conversation about what the advertising base business is going to evolve to. Clearly, we as you mentioned, Chris, we talked Azure, which is Microsoft's cloud professional cloud business. The cloud business for Amazon is such a big driver of both their profits and their growth. So listening to what they are talking about from the cloud side, but it sounds like it was a pretty impressive quarter. So I would expect the stock to be up as well too. Maybe going against that $1 trillion market cap of Microsoft.
Yes. Roheen asks, what's your take on the stock market right now? What sectors should we avoid and what should we focus on?
Well, I think overall, like I said before, the stock market, the U.S. stock market by the S&P 500 really has had one of the most impressive runs, January to April runs in the last 100 years or so. So it was a very tough December, so it's rebounded very aggressively. From that, tech has really been the winner in that space. Tech continues to be the winner. And I think it's fair to say we are bullish on the tech space and companies that can take advantage of technology trends, all the ones we mentioned today, Twilio, Workday, Microsoft, Facebook, and Amazon as well too. So I would say, again, if you are a long-term buyer, continue to be an investor and be a buyer. I would say we are thinking also, though, if you want to hold back some cash, 10, 15% of your portfolio, I'm probably somewhere in the 7 to 8%. After paying some tax bills, probably in the 7 to 8% range. But I think probably if you want to hold some cash aside, that's smart because we will see some prices drop over the next 2-3 years at least, and that will give a better buying opportunities from today's prices.
I'll just add that it seems like one of the stories we talked about in 2018 was consumer products, packaged goods. That was such a troubled industry last year. It seems like things have turned around a little bit for the industry this year. So in terms of like industries to avoid, if we were having this conversation last year, I would put that on the list. I don't think that's necessarily on the list anymore.
Well, Chris, yeah, you're kind of sticking the knife in my back there, because we have a long short service that is short some of those stocks, and it's been painful. They really, you look at like Hershey's and ConAgra, a few of these companies, actually a lot, outside of maybe Kraft Heinz, which was by far probably the worst performer in that group. When you think about the challenges they face on the secular side, but what they've been able to do though is maintain prices, and that was actually a very big surprise from an innovation perspective, going against lots of other younger private consumer products goods companies. That's a challenge for them and will be. And speaking of trouble and challenges innovating, they do have those, but they've actually had some pricing power and been able to raise prices, and that's actually kept a lot of the growth, and that's all profit, right? So that's all profit for them, and they've exceeded a lot of the analyst estimates, and that's been good for their stocks.
It's a great point, and it is one of the things that we love to see here at the Motley Fool is companies that have pricing power. I mean, it's the thing Warren Buffett himself has said. He loves to see that quality in a business, and we've certainly seen that with businesses like, Apple, Costco, and their ability to raise their membership fees over time. You're right, we actually don't really think of consumer products companies as having a lot of pricing power, and certainly in the case of Procter & Gamble over the last couple of quarters, they have flexed that muscle, and that's been a nice surprise for shareholders.
Yeah, you just think about from a private label perspective, how many, you go to the grocery store, for example, and you just see a lot of private labels out there. Now, that's just been a struggle for them to be able to compete against those. So that was one of the thesis last year. I think it still is accurate, but with the low inflation, but they've had the ability to be able to do it over the last quarter or so, and that's shown up in the stock price.
Several people are asking, what do you guys think about Snap? Is it finally time to give Snap a chance?
I don't think so. I mean, this is my personal opinion. I don't think it's one that I would want to be chasing at this level. Speaking of the competition they're facing, just the challenges they're going to be able to have to continue to grow that system, to find growth there. We saw a really nice number from a report from Twitter this week. Otherwise, though, just these platforms that are facing these bigger gorillas, in the likes of Facebook and others, I think that's just going to be a tough space to play. So that's not one that I'm interested in looking at.
Nolan asks, there are a lot of messages in the chat box on YouTube about Chinese stocks, but nobody's mentioning Tencent. What gives? I think that's really more a question for the other people who are watching, Nolan. But, what do you think of Tencent?
Well, I think it's the whole Chinese market in general has just been not this year, but over the past year or so, has really been struggling as they've been finding their kind of sea legs in a slower growth market, and it's been hitting some of the Chinese stocks and many that we like and still look at long term as being good investments. And I think Tencent captures there. I mean, just talk about the big gorilla in that space for China, and Tencent jumps to the list, and that's not going to slow down anytime soon.
Brian asks, what are your thoughts about Pinterest? Another recent IPO, did pretty well.
It did do, yeah. I think the stock, it's done very well. I can't remember the numbers off the top of my head here. It's an interesting business, and we just put out a report, just taking a look at it. We don't have a recommendation on it, so I think again, when you look at the space, the tech space, the consumer tech, really, and if you're trying to find companies that truly have that edge and that uniqueness, Pinterest does jump out. A Snap, I would have thought that might have been one, but when you start kind of like digging under the value for them, I think that kind of quickly evaporated. But Pinterest has some real advantages there, and it'll be interesting to see how they actually evolve and grow that business. It
will be interesting to see, and it's worth pointing out, I mean, Pinterest went public just in the last few weeks at about $16 a share. It's now around $28 a share. Important to always remember that when a company gets ready to go public, the documents they're putting together, they are I'm not saying they're falsifying, because they're not falsifying, but they are dressing up those, they want those numbers to look as good as possible so that when they go public, there is that interest. It's very different to be a public company than a private company, which is why a lot of times we say, hey, you want to see how they do those first couple quarters, in part, how they deal with questions from Wall Street.
I think that's a great point, Chris. I mean, like they certainly are talking to bankers and talking to investors behind the scenes, but once you get out in the public markets, it is a little bit different. It is different, and the stocks start trading on things that you might not expect them to be trading on. So I think Pinterest, from a user perspective and from a uniqueness perspective, has a lot of assets going there. It's not one that I own or have recommended. Again, it's so early in the public markets. But watching how it evolves and how the management team evolves as a public company is an important point for all IPOs, whether you're Pinterest or whether you're Zoom or whomever.
All right, last question, and then we're going to have to wrap it up. Mason asks, what is your favorite non-tech stock? I'll just say from my perspective, my favorite non-tech stock is Starbucks, because I don't know what technology is going to look like in 40 years, but I'm pretty sure I know how coffee is going to get into my system in 40 years.
Yeah, that's
the same way it does now.
Yeah, exactly. And not just coffee. I mean, Starbucks is doing a lot of other things besides coffee, but that is primarily, and coffee prices have just dropped like a stone, so that's going to probably help their business overall. One business that we like that's a much a smaller business that is really not tech at all is Ollie's Retail Outlet, which is symbol OLLI, which runs what they call as semi-lovely discount stores, mostly here on the East Coast in the Central, but looking at that company and how they are growing and how their founder is growing that business and owns a significant amount of stock and has long-term interest in seeing that business succeed. So that's a really interesting and fun company to follow, with not many stores and not in many states, so a lot of room to expand.
All right, Andy Cross, thanks so much for being
Chris.
here. Thanks everybody for watching. We really appreciate it. Again, check out that report. 5 stocks. You can go to fool.com/YT to get all 5 stocks in the free report. I'm Chris Hill. Thanks for joining us, and we'll see you next time.